From markets, let's move across and chat with the management, Suprajit Engineering, and we thought we'll, get them, take a stock of the three-brand strategy that they've adopted, the headwinds on the margin front, whether or not they're easing out, and what then is their outlook for the next fiscal. Ajith Kumar, the CMD at the company, joins us on the show right now. Ajith, hi, morning. Firstly, wishing you a very happy new year from all of us. Tell us, how is the three-brand strategy shaping up and the growth that it's likely to yield over the long term?
Good morning and thank you for having me on your channel. First of all, Happy New Year to you as well as to your viewers. Year gone by has been pretty good for us, although as your earlier speaker was talking, last 2-3 months have been somewhat tepid. However, our three-brand strategy, one for the automotive space, one for the non-automotive space and one for the lamp space, has had good traction, and we continue to believe that although first half our growth has been somewhat lesser than our normal pace, we still believe that second half will be good. Although Q3 has been somewhat muted in the Indian automotive scene, we see that our aftermarket has been solid, our exports of automotive has been solid, as well as there has been a good traction in the non-automotive space. So overall, we have had a good quarter. So with the dollar rupee now reversing in our favor, rupee has from 73 has come down to about 70, below 70 as of last day of the year. The currency fluctuation also will be aiding us favorably in our P&L. So we see a pretty good time so far, and going forward we expect to continue to have a robust business as I see it.
Revenue mix that you're looking at currently, how are you positioning yourself on that front?
Sorry?
Revenue mix that you're looking at segment wise.
Yeah, okay. I think we are fairly well split in the two-wheeler space. I think our on a consolidated basis our split will be about 33-34%, and I would say about 20 to 22% in aftermarket, in the automotive space as well as in the non-automotive space, making up to the 100%. So we have fairly well balanced product and sector mix. As you know, about 10 years ago we were 95% in the two-wheeler space. Now, even in terms of global and Indian business, our Indian business will be about 58 to 60%. 40% will be outside of India, our global business. That 40% is expected to grow robustly in the next 2-3 years' time. So we expect that eventually we will go to 50-50 split pretty soon in the next 2-3 years' time.
What about headwinds on the margin front, especially because of currency fluctuations? What's the expectation on margin performance?
Our margin guidance at the EBITDA level is on a consolidated basis that we will clock between 14 to 16%. In the first half, it was 14.5%, about 75 basis point below our last year's performance. But over the end of the year, we'll be in that same band. I think probably somewhat higher than where we were in the first half. It's just that in the last 2-3 years, our margins were more closer to 16%. So, but we are well within our range. So that continues to happen, I guess. And we continue to be hopeful and confident that in the next years, also we'll be in the same band of 14 to 16% EBITDA.
Right. So moving forward, tell us, how is the scenario looking for in the second half in light of the muted auto demand? What kind of margins are you projecting for the end of this year?
The Q3 has been, for the Indian OEM automotive manufacturers have been certainly muted. As we see it, the first, let's say up to November, the numbers which is available for all of us, the car automotive has grown only about 2-3%, whereas two-wheelers still clocked about, I think, 11 or 12%. Within the two-wheelers, two of the top four are having a single-digit growth, whereas other two are having a significant double-digit performance. So, since we are working with all the players, for us also, on the OEM business side, there has been a minor setback, but that has been easily offset by our very robust aftermarket business as well as our automotive exports. So, we have multiple balls in the air. So, some of them have, gone up pretty high. So, overall, we are still comfortable as a basket. And our growth for the third quarter, which is been a fairly muted quarter for Indian automotive, we are very much on the budget. So, we are quite fine with it.
Okay. Your four-wheeler market share expanded to 35% from 20% 5 years ago. But in the current market, how are you looking to increase the number of clients?
Within India, we have certain space on which at which we work. But what has happened globally, particularly in the European and North American markets, we have been able to get new traction. In fact, as I had mentioned earlier in the earlier interviews, that we are setting up a brand new plant exclusively for export of cables for the global OEMs. That includes BMW, Volkswagen, Renault, Nissan, Ford, etc. Both for the European as well as the US market. So the traction what we are getting is in the international business of OEMs. That continues to be strong. In fact, in the next 3 years, we expect to double our automotive OEM exports of cables from India to our global customers.
Okay, we leave it at that. Thanks very much for taking out the time to speak with us this morning and share with us your expansion plans. Mr. Rai, we wish you the very best for the future and very happy New Year to you too.
Thank you.